Welcome back. This is not financial advice. And today we're going to be giving you a live view of one of my several portfolios inside of M1 Finance. I'll ask you to like the video and subscribe to the channel. And, to start this video off today, I think a little bit of context is necessary. So, back in early 2021, as I was receiving stimulus checks and I had made the decision that I should be investing this money for my future, I was doing a lot of research, and the thing that drew a lot of interest and attention from me was different philosophies around portfolio construction. And so there's always that question about ETFs versus individual stocks. But when looking at a portfolio construction overall, there's questions about whether you should have a highly concentrated portfolio, or a portfolio where your higher conviction bets hold a larger percentage of the pie, whether equal weighting is a good strategy. And then again, there's also questions about rebalancing. Do you rebalance or do you let the winners run? And so those are some of the things we're going to be discussing in today's video right after this.
You need to diversify your bonds.
The only problem you're gonna have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
So as we're getting into this, we're looking at one of my portfolios, which is entitled 50 Equal Weight Stocks. And this represents about 15% of my total holdings. And it is a unique strategy, a strategy that I um, tried out and I think that I like and I think will remain a piece of my portfolio moving forward. And so basically the philosophy on this is the coffee can investment philosophy, which is really well described by another financial YouTuber. Can't pronounce his last name, but a CPA named Nathan has a YouTube channel where he sort of highlights, the pros and cons of the coffee can method of investing. So let's go over there and see what he has to say about it.
Robert Kirby was sitting at his desk one day when a client of his, who had been with him for many years, came into his office. She said her husband had just passed away and she needed to consolidate his assets with hers. So she handed Kirby the investment statement, and Kirby looked at it, and at first he was pretty amused. It turns out that the husband was piggybacking off of Kirby's advice. He was copying all the buy decisions that Kirby was recommending to his wife. But when Kirby got to the bottom line total value of the account, he was shocked. But the husband did something different and very interesting. Rather than following Kirby's advice to sell stocks or trim stocks, he just put $5,000 in each position to start off with, and he didn't do anything else with it for the rest of the time. So in the same example, he had stocks A, B, C, and a bunch of others, and we'll say he had $20,000 invested in each one, just like the other example. But when this stock turned to $40,000, he did nothing with it. He just let it win. And this one, when it dropped to $10,000, he added no money to it again. He just let it keep on doing whatever it would do. So decades and decades later, he ended up with several positions that had basically been permanent winners. So one position was worth $800,000 compared with a $5,000 original investment. And some of these other positions were worth much smaller amounts, maybe $2,000. So over the time he owned it, he ended up losing 50% or more. There were others that probably went to zero, but he had a few positions that were worth a substantial amount of money and that more than made up for all these other losing positions.
I think that around April 1st, as I was investing, I just noticed the portfolio going up and to the right with very minimal downside. And so I saw here for these first 4 or 5 months, the S&P 500 return about 13%. And honestly, at that time, I thought, wow, stocks and investing are great. You just put money in and it goes up forever. Now, I knew intellectually or through my research that wasn't the case, but emotionally, it did not set me up for success. So somewhere around this time, when we noticed the market go down from, up 13%. When I saw and felt the market go down only 4%, I kind of panicked a little bit. Um, and that was, looking back on it, it was super duper funny. So once we had a little bit of a recovery, I took profit in some 2020, 2021 stocks that, were very timely. So I had some investments in Home Depot, Dollar General. And if you think about what was going on around uh, mid to late 2021, obviously you could see why those stocks were in vogue. So I took profit somewhere around 17 or 18%, maybe $600, and I decided that I had to change my strategy. That and that was a good thing, honestly, because what I needed to realize at that time is that markets are going to be forward looking. And so I rode the tail end of that recovery after 2020. And I sold out of some of those stocks and entered into some other positions, which are a story for another time. But at that point, we tried this new strategy, somewhere around here. And then I watched as it went up for a little bit, and then I became increasingly confused and dismayed and upset and scared and fearful and greedy, but more so fearful. And I watched the market go down the same way I'd watched it go up around 13%. I then watched it decline around 14%. And I said, man, I must really have this investing thing wrong. And so around this time, after, you know, playing some investments that were, very easy, low hanging fruit, very obvious things, and taking profit, and then, trying to go into a more concentrated and larger bet into some other stocks that I thought were more forward looking, such as Amazon. At this point, I had suffered 20, 30, 40% losses in some individual stocks like Amazon. And so I thought, okay, well, maybe this extreme concentration, this Buffett style of investing is not the right thing for me. So I did not sell anything while that was down. My only profits I've ever realized in the market were around $600. Everything else is unrealized or dividends that have been reinvested. But around this time, I started doing some more thinking and some more researching and came across the concept of a coffee can investment portfolio strategy. So around May 20 of 2022, we were um, just a little bit more than halfway into the 2022 bear market. And I did see an opportunity here to get some exposure to some stocks that historically had always been too expensive or would have been at too high of a valuation for me to participate in. So big chunks, big slices of America, institutions I wanted to own. And so I saw this downside as an opportunity, which is correct investor, behavior. And at that time, I opened up a portfolio with 50 equal weighted stocks. So we can see since May 20th of 2022, the market has returned about 21%. So coming back into my coffee can portfolio, what we see here is sort of the chart or the performance of this portfolio over the last, I don't know, year and a half. And so what we can see here, when you see these little little ratchets, little divots up, these were bi-weekly contributions of $250 spread across the whole 50 stock equal weighted portfolio. And so it was probably about a year and a half of active investment into it. And then at this point, I decided to let it ride on the strategy, and I stopped making contributions around 3 months ago, where we saw the portfolio go down in value, but then it's participated nicely in this rally that we've had recently. And so just taking a look at this a little bit further, we can learn some more things about it. And so M1 Finance, the way that they track or report gains are a little bit wonky to me, and I don't really agree with them. But we can just see here a market gain of around $1,450, but also dividends earned of around 155. And so it does say here that I'm up 37%. That's not accurate. But let's look at some of the holdings here together, and then we'll dive into the performance as well. And so as you can see here, a little snaggletooth, a pretty good situation for me. You know, um, the story of 2022 was, a pretty sharp bear market for me after my first 6 months, knowing nothing but being in the green and having stocks go up. And so the story of 2023 was that of the magnificent seven of seven stocks. And if you didn't own these seven stocks at equal weight or overweight, you didn't do well. But that wasn't the case for me through the tail end of 2022 while the market was down. And in 2023, while the market was mostly flat, with the exception of those seven stocks, I actually had some really nice performance. And so I did follow the coffee can investment philosophy, but with a modified approach. So I didn't have $1 million to invest. But I started off with $700 or $800 and investing $250 every couple weeks. So I did dollar cost average into this equal weight strategy. But I would say that it is a fair representation of a coffee can strategy because I never rebalanced, never sold, never took profits. I just simply reinvested. M1 Finance did the work for me, buying the underweight positions. And when I received dividends, I went ahead and just bought the very lowest position, independent of anything else that was going on. If it was the lowest in terms of dollar value, that's where the dividends were reinvested. And so, even though I wasn't equal or overweight to the Magnificent Seven throughout 2023, I've actually had some really nice performance. And I would say, looking at 22 and 23, my performance probably was pretty dang close to the market. What we can see here are all of my holdings, and they're going to be organized by value. I think what I would like to do is I'd like to organize this by unrealized gains. So we'll take a look at everything. Now, the market's up around 21%, and I'm up around just under 18%. And so it's sort of hard to back test starting in the middle of the year. But I think that it's close. It's close. And I was a little bit down on myself until I realized that this 2023 bull market has been all about seven names. And I picked names other than that to be higher weighted. And I've had some, good returns. $1,500 of unrealized gains, $150 in dividends. And so just looking here, some of my highest performing, companies that I guess in this period of time, the market's been up 21%. So I'll just sort of shout out the companies that have been outstanding for me. Coinbase, unrealized gains up 222%. Meta, Facebook up 167%. Netflix, 74%. Williams Sonoma, 68%. Salesforce, 55%. 52% on Intel. 47% on Amazon, 45% on Tesla, 39% for Microsoft, 37% for Google, 35% for Costco, 35% for Mexican Coke. And so these are companies that have done really, really well. Markets returned about 21%. Let's cover the rest of these that have outpaced the market. So Caterpillar, Vertex Pharmaceuticals, Apple, Winnebago, Casey's General Store, Wheaton Precious Metal, and those are the ones that have outperformed. And then, so what I'm going to do now is I will take us down to the ones that have performed sort of close to or under the market, starting with Domino's there on the top, and then ending with, let's say, McDonald's down on the bottom. And you can just sort of see the dollar amount and percentage that's been returned. And you can pause here if you want to sort of examine these a little bit closer. And I'll ask you to like the video and subscribe to the channel as we continue diving into the performance on this. So starting here with some companies that haven't performed as well, we have Seneca here up 7.3%. And I'll allow you to sort of pause this and look down if you want to look through these. We'll hold it at Starbucks, where I'm up 0.8%. And now we're going to move down and we're going to see the laggards. So out of 50 companies, if I did my calculation right, this is actually pretty astounding. Out of 50 companies, I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So I have about 89% of my companies, 88, 87% of my companies that are positive over this period of time. But pausing down here at the bottom, my biggest loser has been Dollar General, Walgreens, so on and so forth. And you can sort of see how all these other ones have performed under this strategy throughout this time. But moving right along, I wanted to show you some different statistics on this portfolio that I think are helpful. So, I believe that I'm at unrealized gains of around 17 or 18%. I think the market is up around 20 or 21%. And sort of the way that I've been buying into this, I don't really have a way to back test it. So I have a suspicion that I might be right on pace with the market, because there's definitely, many buy-in times versus just looking at the market and saying, if I bought here and ended up here, I can't really simulate dollar cost averaging on that same basis. So I'm pretty dang close. In the context of everything, I'm pretty satisfied with that. But there's some data here that's important. So I have an expense ratio of 0.01%. So a quite low expense ratio, and then a nice dividend yield of 1.9%. And so I think that, seeing that I have a portfolio of 50 securities, the majority of them being stocks, but some of them being ETFs, I'm seeing a pretty attractive setup here as far as super low expense ratio and then a nice 1.9% dividend yield, which is certainly a nice yield for a portfolio if you're looking for dividend growth over time. And I've definitely always enjoyed reinvesting those small dividends that will snowball into larger dividends. But just to round out this video, in contrast with the S&P 500, you can see that the S&P 500 has a dividend yield of about 1.5%. I have a dividend yield of about 1.9% on this portfolio, and my expense ratio is about two-thirds that of the very cheap VOO S&P 500 Vanguard ETF. So if you enjoyed this video, like and subscribe on your way out, and I will see you in the next one.